Good morning. Welcome back to the Broadcast Retirement Network. This is BRN Weekly for Saturday, July 13th, 2024. And our top story today, U.S. inflation is cooling faster than expected. And joining us now to break this all down, and joining me now to discuss this and a lot more, Jane King joins us from the NASDAQ. Jane, so great to see you. Thanks so much for joining us again on the program this morning.
Great to be here, Jeffrey.
Well, it's been an interesting week to say the least. We won't get into some of the current event issues, but let's talk inflation. And I took a look at the CPI announcement, and it looks like overall inflation has cooled. Want to get your reaction to that and then talk about markets.
Yeah, first drop that we've seen since 2020. So it's been a long time. Just 0.1%, not a big drop. It was mainly led by energy. We did see housing and car insurance, medical costs. Those things are still rising, but energy dropped enough. Some food products dropped as well. Used cars fell as well in June. So that was enough to offset the higher prices of things. But like during the late 70s, early 80s, we'd see a drop in inflation and then an increase in inflation. It didn't just drop and then drop for good. It kind of went back and forth for a while. So, and in fact, the PPI that we got on Friday morning showed a gain. So we could be in kind of a little bit of a range with inflation for a while.
So how did, I know the markets really pay attention to what Jerome Powell and the Federal Reserve, what they may do or will do. How did the Fed react to some of these reports on inflation? Are they bullish on interest rate cuts? I know they keep a lot of cards to their vest, but
Yeah.
can you make hide or hair of what Jerome Powell said?
I didn't hear much from the Federal Reserve Chair, but when you look at the Fed funds market, it is pricing in an interest rate cut, maybe two this year. So we're all of a sudden back to this, and perhaps as early as September. I think a lot of it's going to depend on what the August numbers say and what the jobs numbers say and things like that. They're probably going to make that decision at the very last minute.
Jane, I want to talk about markets, but I want to ask that about in the context of Pepsi. I think we had some earnings numbers this week, maybe disappointed. And I'm surprised, by the way, that Pepsi, because I know it's maybe not the healthiest beverage, but Pepsi is a staple of Americana.
Yeah, well, they have all those snacks as well. And in fact, they said in their earnings, they acknowledged that they've been raising prices numerous times. And they acknowledge that, and not just budget conscious people, but higher income people are watching what they're spending on food. And so they hinted that they might start cutting prices on snacks at some point in the future. So this is how these things happen. We start to see it, then maybe, some other snack companies cut as well. And that's how we can get those inflation numbers back down. But Chase CEO this morning, Jamie Dimon, said that he thinks interest rates and inflation may be higher for longer than what the market expects. So that's kind of lingering out there as well. So next 6 months are going to be really interesting to watch.
Yeah, I find it interesting that here we are kind of flipping back to, we had talked, we had been talking about one rate cut, two rate cut. Now we're kind of back, and we thought, I guess the market thought, not we, but looking at the market built in one rate cut. Now it's so interesting that things have kind of flipped back and how bullish, I guess, the market is looking at this one number. I don't know, maybe the cart before the horse here.
Yeah. Well, and if you look at the stock, oh my gosh, we haven't even really had a correction this year. I thought we might. Well,
Don't say anything.
we've talked about this. The standard deviation would tell us that we're going to get one. I mean, just by the law of averages, but astounding gains first half of the year. And I think that was all in expectations of interest rate cuts. And now that we've got our first CPI that went down, maybe this is a buy the rumor, sell the fact kind of thing. We'll just have to see.
Yeah, Gene, there are a lot of doom and gloomers. Look, you and I are kind of both we're both journalists and in the media, and that's what sells, that's what gets the clicks, all that kind of stuff. There are a lot of doom and gloomers that I see on some of the media shows talking about how there is going to be a correction, there's going to be a recession. Jane, I've been hearing this. I don't know. I've been hearing this for like the last decade. I've been hearing this since the last recession.
Yeah, right. No, for sure. They've been calling for that for a couple of years. And in fact, somebody at one of the big banks lost their job because they had stood by a recession call and it didn't happen. So, can be kind of brutal, Wall Street sometimes. So, yeah, I mean, we'll just see. But my argument was that when you look at just the law of averages, I mean, we can't be up 80% this year. And so, I mean,
Yeah, I
maybe
mean,
I guess anything's possible, but chances are that won't happen.
yeah, I'm reminded you were describing someone losing a job. I was thinking about The Big Short, if you've ever seen that movie. There's a
Yeah.
scene towards the end when 2008's about to happen, the market's about to collapse, or Lehman's about to collapse, and Steve Carell's character basically says, "Would you, they're asking this other guy, would you buy more? I think Lehman stock." And then Lehman stock, they were talking creators, and Carell says, "Boom!" Right? And so that kind of reminds me of that. I think it's a wait and see, and I don't know. The doom and gloomers, the prognosticators, the Nostradamuses out there. I don't know. I take it with a grain of salt. Jane, we're going to have to leave it there. Great to see you.
Okay.
Thanks for joining us. We look forward to having you back on the program again very soon.
See you next week.
Thanks, Jane. Always great to see you. Thanks for sharing your perspective. And when we come back, we take a look at some of our best segments for the week. And I want to stay tuned right here on BRN Weekly. Now is your opportunity to co-create content around any topic on the First Lifestyle and Wellness Network. Reach a global audience through our platform and co-own exclusive branded content. All of our programs are available on demand and also as audio-only podcasts, so you can take us on the go. Broadcast Retirement Network, available anytime, anywhere, and on any device. Welcome back. It was another great week of shows with great topics and, of course, great guests. We kicked off the week looking at how rollovers from employer-sponsored plans to IRAs have grown overall. Let's take a look.
It's a big opportunity, and it's an opportunity in the billions. So if we look at Cerulli research was done in 2022, and they calculated that over $780 billion in assets came from retirement plans and were rolled over into IRA accounts. They also project that that's going to increase to 200 in 2028 to over $900 billion. So there is a significant amount of money in motion. Then when you look at it, you say, what are the driving factors here? It's demographics, right? We're entering a point in time where the peak 65 is here. That's the new expression, and that's a high majority of the population is turning 65. I think the numbers are 12,000 people on a daily basis turn age 65. So, and we're seeing that growth on our platform. Last year, our platform, the assets rolled over grew by 20. And this is an established platform that's been in the marketplace for over 10 years. As we look at the rollover marketplace, obviously the source is the record keepers. That's where the assets are. And what we've seen over this year and previous years, we've seen that record keepers are offering their own IRA product or an affiliated product. So they're involved in it. We have your traditional IRA providers, which are your discount brokers, asset managers, broker dealers, RIAs. They're involved in this and play a part in it. And then we're also seeing recently a big push by advisory firms. And we're seeing some come on the platform who have the affiliation with the plan advisor. So the plan advisor might be with that particular advisory firm, and then the pathways are created for the rollovers to whether a wealth management team or to that particular plan advisor. The advisors want to be involved with that participant. They want to participate in that bridge from retirement to wealth. As we look at individuals, their largest assets now are in retirement plans, and the advisors want to participate in that. And then you spoke earlier around generational wealth. So this is that opportunity for that advisor to get in between that generational wealth and help extend and grow their business as well, and their relationship with the family, not just that individual. The whole process in general is prone to errors. It's prone to leakage on the IRA rollover side. It is a difficult place with that back and forth of the paperwork. So one of the great advantages that we have, instead of the manual process, which can take 30 to 90 days to execute on, leveraging technology, leveraging middleware technology, which connects that record keeper to the IRA provider and provides a good experience for the participant, those can be funded in 3 to 5 business days.
Next up, we discussed shaping, or is that reshaping, the future of the retirement system. Let's take a look.
That's a great place to start, Jeff. And I think the history of the retirement system is one of continuous improvement, right? With policymakers working together with retirement providers. Legislation plays an important role in continuing to make a secure retirement a reality for Americans. It has enabled employers to confidently implement changes to their retirement plans that don't require employees to take any action, but set them up for consistent savings that can grow over time. So the things like tax incentives for retirement contributions, auto enrollment, auto escalation, target date funds as QDIAs have been a key to making a retirement a reality for many people. And these were all enabled by legislation and regulatory action and then implemented by employers and plan sponsors. These have been important changes, but there is more to do. Successful policy improvements like the Secure Acts have driven great innovation in the workplace retirement system. And I just wanted to talk a little bit such as turning savings into income, right? One of the key provisions in the 2019 Secure Act provided the guidelines for employers to use when looking to add a lifetime income guarantee investment option within their plan, and provides the fiduciary safe harbor for the selection of an insurance provider. And also it added in, the need to calculate lifetime income that gets added once a year in a participant statement, and also added the portability provisions, which were very, very important as well. So the safe harbor essentially means that plan fiduciaries can now rely on a written representation from an insurance company that the insurer satisfies the stated requirements. As long as they get the written representation, they are protected from being held liable if the insurance company becomes insolvent in the future, or otherwise that does not have the financial capabilities to provide the income payments to the participants. So this is huge on giving fiduciaries peace of mind. It was a big concern of theirs. They're not putting the plan or the plan sponsor at risk when they choose to enhance their retirement plan by adding this solution. And they can focus on the benefits of these products that help participants protect their savings and secure income for the rest of their lives. The other, if we think about, I was just going to also wanted to talk a little bit about Secure 2.0 for a second.
Yep.
Right. So I think another great opportunity where legislators and the industry talked about and understood the burden of student loan debt on people's ability to save. And that provision, building off of the private letter ruling that was in existence from Abbott Labs and making that now into law, I think is another great way that the industry working together with our friends in Washington to be able to help provide enhanced retirement savings. That's why I've always said that the Secure Act in 2019 was the most important part of legislation since Pension Protection Act, or PPA, back in 2006. And I think that Secure 2.0, obviously, emergency savings accounts, the student loan provision that we talked about, and there's more to come. I think over time, right? The dialogue will continue as we work with the legislators and regulators on what we need to bring next. Yeah, so I think about that being the other half key provision, right, of Secure Act 2019. And that coverage gap, I think, really exists primarily for small businesses. So we see the research that shows as an employer size decreases, they're less likely to offer a retirement plan. It trends down from 90% of employers with 500 or more employees offer a retirement plan to only 52% for employers with fewer than 50 employees. And that equates to 22 million companies across the US that don't offer a worksite plan, affecting 57 million working Americans. So we think it's really important. We brought a focused effort to bring solutions to small businesses. Small businesses, right, are the growth engine of the American economy. They employ nearly half of working adults in the U.S.
Right.
So we look at an array of solutions there under this broad category of group plans, right? So for any type of small employer that we do, whether they see the ERISA administration as a particular hurdle, or thinking about the costs associated with plan audits, et cetera, we look at just group plans, whether it be a multiple employer plan, association type programs, or an aggregation program, or the pooled employer plan, which came out of the Secure Act. They just make it less daunting for employers to start a plan. So we've rolled out pooled employer plan offerings on multiple platforms, but we also look at association programs as well. And in all of them, one of the common characteristics is looking to be able to offload some of those fiduciary responsibilities to other service providers that can take care of that that fiduciary role for the plan sponsor, and the plan sponsor and the employer really effectively has one decision, and they are thinking about adopting or implementing a plan. One other area of focus is just, holistic financial literacy education. And one of the things that we really saw coming out of the pandemic and from a lot of the research that was done throughout, right? You had individuals with all different facts and circumstances during the pandemic dealing with different challenges of not having, needing ways to address income gaps, or just looking broadly at their financial well-being and the impact on mental health. And all of that, we look to be able to help participants through this holistic financial education, really help them to manage their finances, set goals and saving for retirement, and look broadly across their financial, all of their finances, to be able to make sure that they've got all the right protections and savings programs in place.
Now is your opportunity to co-create content around any topic on the First Lifestyle and Wellness Network. Reach a global audience through our platform and co-own exclusive branded content. All of our programs are available on demand and also as audio-only podcasts, so you can take us on the go. Broadcast Retirement Network, available anytime, anywhere, and on any device.